Hi guys, Mark Shawzen from the Pattern Trader here for a special intraday report. It's Tuesday, August 25th, and unless you've been living in a cave, you'll know that there's been absolute pandemonium in the markets for the last 3 or 4 days. The major U.S. stock indexes have fallen over 13% from their highs just 2 months ago. And in the last three trading sessions, we've had 3% declines in each of the last three trading sessions, which I believe might be a record. So I'm getting an avalanche of emails, calls from our subscribers saying, Mark, what the hell's going on here? I'm watching CNN, CNBC. They don't know what the hell they're talking about. They're giving me all kinds of mixed signals. I have my whole portfolio in the stock market. What should I do? So we're going to do a special intraday report. Hold on to your hats and take a deep breath. And actually, there'll be a silver lining for those long stockholders after our analysis. So wait till the end, and I believe you'll be happy with the outcome. Yeah, it really riles me, when I see these guys on CNBC with a huge double top chart pattern behind them or a descending wedge, and they're talking about all these fundamental metrics and things that are coming out after the news and telling you why you should buy something. Meantime, the chart, behind them is screaming that you should get out as, quickly as you can. These guys are paid millions of dollars a year by Wall Street. They don't know what the hell they're talking about. It's not that I'm so bright and so informed, but basically my whole philosophy is that the market's always right. The market patterns tell you exactly where these markets want to go well ahead of the information. So the markets are counterintuitive. The markets are a discounting force. The markets are anywhere from 3 months to 9 months ahead of the information. So by the time the guys on CNBC are telling you to sell because China's in a manufacturing slump or whatever manufacturer concocted opinion they came up with that day, it's already too late. The market's moved and the information was, well ahead of their prognostications. And we're going to show you exactly what we're talking about. If you just understand a couple of price chart actions, price action, you'll be well, informed to, make much more informed decisions on your portfolio over and above what those turkeys are talking about on CNBC or your analysts at Goldman Sachs, etc. So let me highlight what I was seeing back in July 26 when we initiated our first major screaming sell recommendation, which came right here. We had a key reversal in the NASDAQ. It made a new high and closed on the low. Now that in and of itself shouldn't have been a major sell signal, but we were watching many other things. One of which was this is the NASDAQ. The NASDAQ went ahead and made a new high at the 4,700 level. But if you notice, and I know that these time frames are condensed now and the charts aren't that apparent, but if you notice at the same time, the S&P came up just about to its prior peak. So while the NASDAQ went to a new high, the S&P didn't quite penetrate its old high, and the Dow Jones was well off of its highs. I know it doesn't really show you here, but the old high in the Dow Jones was around the 18,700 area, and the new low there was about 18,400, so that there was what we call a negative divergence. So let me show you what I'm talking about. The fact that this market, the NASDAQ, made a new high at 4,700 and the Dow Jones did not even come close to its old high was what we call a bearish divergence. So that was our first indicator. But then, digging deeper, I was looking at some of the patterns, especially in the NASDAQ. So I'm going to drill down to some patterns now to show you exactly what I was looking at that informed me for that sell trigger on July 26, about a month before this major decline. Okay, so in this chart, we're taking a closer look at the NASDAQ 100 tech sector chart. This is one of the key formations that initiated that sell trigger, which came in July 26th right here, where we basically issued a special video report. It was entitled Ominous Technical Signs in the U.S. Stock Market. And it turned out that it was extremely prescient in terms of what we thought the expected outcome was going to be in a number of different ways. Not only in terms of calling the market, but actually creating a target for our sell decline. And we basically hit it on the nose yesterday. So let me show you what I was looking at the time. So basically, this is what I was looking at. What I call the reverse wedge or megaphone top. It's called the megaphone top because of this triangular shape formation, but it's really known as the reverse wedge triangle. And you can see from the peak to the neckline of this triangle is about 400 points from top to bottom. So we projected that, and this was early, again, our initial sell order was right here, July 26, at or around the 45.56 area. We said that if this formation was completed at around the 4,300 area, that then it would project much lower. And because of the price level from peak to trough was around 400 points, we projected that if this was to break the neckline, that it would project down to about the 3,900 level. And guess what, folks? Intraday yesterday, it hit 39.02. So right on the nose. That's exactly what was our projected target. And based on the fact that it hit there and some of the intraday price action, we actually started lightly buying the NASDAQ 100. So what's the outcome going forward? There's a lot of craziness going on in the market. People are wondering, is the bull market over? Is this 2008 repeat? Is this going to blow up into a full stage crisis? And I think the good news here is that the reverse wedge triangle is basically a very unreliable bearish triangle. So once it breaks, the reliability of its continuity is not very great. So that while we started lightly dipping our toes in here, if this thing were to come back to the neckline around the 4,300 area here, that's when we would start buying it, for real. And typically it might take 2 or 3 touches. So it could bounce, come back. You get the picture. So if it touches here and bounces a couple times and then eventually shows that it wants to go through, this actually would signal a tremendous buy opportunity. So that we think that there was a tremendous pent-up sell-off that was imminent in the stock market. This has been the longest post World War record of a bull market without a 10% decline. So basically, I think since 2008, we haven't had a 10% decline in the markets. It's been straight up. As we always say, trees don't grow to the sky, and this market was just due for a break. And just like anything else, it came quickly. It was a tremendous shock, but I think once we get our bearings, this market will stabilize here and might even continue up. Like I said, I would wait for final confirmation for those of you who are a little bit more conservative at the 4,300 area. Watch the price action there. Stay alert to our emails. We'll tell you exactly where to get in, where to set your risk. So if you want to follow on with our analysis, you're sick of watching the bozos on CNBC, go ahead and click the link below, and we'd be happy to send you our trades for the next 14 days absolutely free. So we look forward to having you come back. So have a healthy and prosperous trading day, and we'll see you next time.